In Chapter 6, we learned about how costs react to changes in volume. And in this chapter, we're going to look at cost, volume, profit analysis, where we can see how not only costs change when volume changes, but then also how profit factors into the mix. So we look at all of those relationships between cost, volume, and how that affects your profit or your loss. And so we can use this CVP analysis for some projections. For one thing, we can determine how much we need to sell in order to break even. We can also then look at what sales volume we need to reach a target profit that we perhaps have promised to our investors. So the things that we need to know: the sales price per unit, the volume sold, the variable cost per unit, and our fixed costs, and then we can determine our profit or our loss. And we're going to be looking at this very simply. We are going to assume no volume discounts, although we know if you have a relationship with a supplier that perhaps if you're buying things in great volume, the price will fluctuate, but that will complicate what we're trying to do here. That we're staying within the relevant range. We won't be changing the inventory levels and the sales mix. The sales mix is when you have more than one product, how much of one product you sell for every unit of another product that you sell. And so just to kind of illustrate some of the things that involve CVP analysis, the example here they give you is that you have a candy store. How many candies do you need to sell to make a certain profit that you have set as your goal? Another thing you could use CVP analysis is to address, okay, how would sales and costs change if we reduced our hours? I sometimes think about that when I go into a store, at 9 o'clock at night and there's hardly anybody in there. You wonder, how is it worth it for them to stay open and pay their workers and keep the electricity on when there's so few customers? So maybe you want to determine what would happen if we worked fewer hours. What happens if the supplier increases the cost of the candy? What's that going to do to our profit, our operating income? What if we then raised our prices by $1, right? We're going to be having, charging our customers more, but is that going to decline the volume that we sell? How's that going to affect our operating income? So these are some things we're going to be looking at when we do CVP analysis. So also back in Chapter 6, we learned the contribution margin statement. So we determined operating income in a different way than what we did back in financial accounting when we prepared the financial statement under GAAP, which was absorption costing. In the contribution margin statement, we took our sales revenue, subtracted our variable costs, and that gave us our contribution margin. We then subtracted fixed costs from contribution margin, and that got us to operating income. So this is what our contribution margin statement looks like, and this is the statement that we're going to be working on for a lot of the things we do in managerial accounting. So we know how to get our contribution margin, just sales revenue minus the variable cost equals your contribution margin. We'll also be using the contribution margin ratio. That tells us what percentage of your sales revenue ends up being contribution margin. So we take our contribution margin and we divide it by revenue. So let's say our sales revenue is 10. Our variable costs are 6. That means our contribution margin is 4 when we subtract. And so our contribution margin ratio would be the contribution margin divided by the sales revenue, 40%. So basically your sales revenue is split between variable costs and contribution margin. So variable costs are, in this example, are 60% of sales revenue. Your contribution margin is 40% of sales revenue. We say our contribution margin ratio is 40%. Here's an example here. Contribution margin is $28,000. Total revenue is $100,000. What is the contribution margin ratio? Again, we divide 28,000 divided by 100,000, 28%. So that means if we increase revenues by $1, contribution margin increases by 28 cents, because the other 72 cents would be variable costs. How about this one? Contribution margin per unit was $4.40. Sales per unit was $8.90 per unit. What's the variable cost per unit? So again, we would be subtracting sales revenue minus contribution margin. $8.90 minus $4.40 is going to get us to $4.50. That's our variable cost per unit. So that's the relationship between sales revenue, variable costs, and contribution margin. Sales price is $5.50 per unit. Contribution margin per unit is $2.30. There's 100,000 units sold. What are the total variable costs in dollars? Okay, so the $5.50 minus the $2.30. $3.20 is the variable cost per unit. So if we sold 10,000 units, the variable cost would be $32,000. A cost that does not change as production volume changes, right? So it stays the same no matter what the volume, is a fixed cost. If the contribution margin is 30% and total revenue is 100,000, what is the contribution margin in dollars? Well, we would take the 100,000 times the 30%. 30,000 is our contribution margin in dollars. So now that we have these relationships, we can now talk about break even. So break even is a sales level where your operating income is going to be zero. No profit, no loss, right? So we are just completely covering our expenses. So basically our fixed expenses need to equal your total contribution margin. So if we want to figure out how many units we need to sell to break even, we take our fixed expenses, and this is the formula we're going to use because then we can just stay with this formula and use it when we're trying to reach various operating incomes. So fixed expenses plus operating income gets divided by contribution margin per unit. We know when you break even, your operating income is zero. So it's basically fixed expenses divided by contribution margin. Okay. If we want to find the sales revenue we need to reach a target operating income, we take the fixed expenses plus the operating income. And if you're just trying to determine if you're breaking even, operating income zero. And then we divide that by the contribution margin ratio. That ratio we get when we take contribution margin and divide it by sales revenue. So let's say contribution margin is 28,000. Number of units is 10,000. Fixed costs are 15,000. How many units must be sold to break even? Well, the fixed cost plus the target operating income of zero, so it's going to be 15,000. And then if it's the units, we want to know the contribution margin per unit. So 28,000 divided by 10,000 will get us our contribution margin per unit. So we're going to take the 15,000 and divide it by 280. The 28,000 by 10,000 gives you 280. And so when we divide, it comes to 5357 point something. We need to round up. You always round up if the break even comes to a fraction of a unit. Let's say we want to achieve an operating income of 20,000. Contribution margin is 28,000, number of units is 10,000, fixed costs are 15,000. How many units do we need to sell to achieve the operating income of 20,000? So we would take the 15,000 fixed costs plus the 20,000 target operating income. So 35,000 gets divided by $2.80, and that comes to 12,500 per unit. All right, so now let's take a look at the target operating income in dollars. Instead of looking at how many units we need to sell, we want to see what sales revenue do we need to earn in order to reach the target operating income. So in that case, we take the fixed cost plus the target operating income, we divide that by the contribution margin ratio. So let's say we had sales revenue of 100,000, contribution margin of 28,000. That means 28,000 divided by 100,000 means our contribution margin ratio is 28%. Next year, the target operating income is 20,000. So the revenue that we need to earn in order to reach that target operating income, we're going to take the fixed costs of 15 plus the target operating income of 20, so 35,000, and we divide that by the 0.28 contribution margin ratio. So we need to earn sales revenue of 125,000. Okay, so just to review, what's the formula to compute the number of units to sell to break even or achieve a certain target operating income? Our formula is fixed costs plus target operating income divided by contribution margin per unit. What's the formula to compute the sales revenue needed to break even or achieve a target operating income? Fixed costs plus a target operating income divided by contribution margin ratio. How do you calculate the contribution margin ratio? Contribution margin divided by revenue. So the next thing we want to talk about is sensitivity analysis. When we're doing projections, okay, we're guessing what we think the sales price is, what the fixed costs are, what the variable costs are, right? And we need to look at what happens if some of our projections are off. So let's say the sales price increases. What's going to happen to the contribution margin? So if we look at the situation, sales price is 150, variable cost per unit 90, contribution margin is 60, total fixed costs are 570. So if the sales price increases from 150 to 160, that means our contribution margin is going to increase. What's going to happen to the break-even point? Well, we take the total fixed cost and divide it by 60, so 9,500 was our break-even. If the sales price increases and the contribution margin increases, then the break-even is going to also increase. The break-even is going to decrease, right? Because we don't have to sell as much in order to break even because our contribution margin and contribution margin ratio was higher. The opposite will happen if sales prices decrease. Contribution margin will decrease, and then that's going to raise our break-even. What happens if variable costs increase? What's going to happen to contribution margin? So if variable costs go up, our contribution margin is going to go down. What's going to happen to break-even? If the contribution margin goes down, the break-even is going to go up. So we can see contribution margin in this example decreased to 50, so then we have to sell more to break even. The opposite's true if variable costs decrease. They decrease, contribution margin increases, break even will decrease. What if fixed costs increase? What happens to contribution margin? There's no change. Fixed costs aren't involved. But if what will happen to the break even if the fixed costs change? Well, we're going to have more fixed costs that we need to cover, so the break even point is going to increase. And then finally, if fixed costs decrease, again, no change in the contribution margin, but then we have less fixed costs to cover, so our break even point is going to decrease.